Well, hello, ladies and gentlemen. This is Shiqi Cai from Wenzhou Kean University, major in finance, and you can also call me Vivian. Today, I'd like to introduce you something about the relationship between margin trading balance and stock liquidity in Chinese markets. First, I'd like to easily introduce about the margin trading and the stock liquidity. The margin trading is a way of borrowing against the securities holdings for investors to expand their returns. The Shanghai Stock Exchange and the Shenzhen Stock Exchange officially opened its margin trading and security leading systems on March 30th in 2010, and the stock liquidity prefers to ease with which investors can completely transactions in large blocks of shares with minimal cost, price impact, and the fastest possible speed. Then there was some literatures I used in the research. We can quickly look through them. Then I'd like to introduce the hypothesis in the research. For the impact of margin trading and on the stock liquidity, I come up three hypotheses. The first one is about the relationship, which is that margin trading and stock liquidity are positively correlated. And the second one is about COVID-19. The positive impact of margin trading balance or stock liquidity is more pronounced during the COVID-19 pandemic. And the third one is about the moderating effect, which is that the firm size has a positive moderating effect on the relationship between margin trading and the stock liquidity. Then let's look about the data. All the data are about the Asia-listed Chinese companies in the margin trading system, and we select the data from Chinese stock market and accounting research database with annual data from January the 1st, 2010 to December 31st, 2021. As for the variables, I choose the amplitude indicator, market trading balance, return on equity book to market value, firm age, firm size, ownership, concentration, operation revenue growth rate, and the capital expenditure in this research. Then is about the methodology. The for amplitude illiquid indicator, the formula has shows in the PowerPoint, and it was used to measure the illiquidity for the stock. And in the research, I mainly use the multiple regression models, and the model is, the formula of the model is also shown below. Then I like to introduce something about the result. The first table is about the descriptive statistics. Then I'd like to easily introduce something about these variables. The first one, of course, is the amplitude indicator, and the zero also means the zero indicator. For the TOV, it was the annual turnover of outstanding shares. Then the margin was the logistic of margin trading balance. The ROE was the return of equity, and the BM shows the book to value ratio. The age is the firm age, and the LEV was the asset liability ratio, and the size was the logistic of total assets, and the large hold was the shareholding ratio of the largest shareholders. The growth was the growth rate of operational revenue, and for the CAP, which is the capital expenditure divided by the total assets. Then for the main regression results in our research. just pay attention to these three numbers. We can find that the first column was the regression between the margin trading balance and amplitude indicator, and second one with the zero indicator. Both these two shows a significant negative impact on the indicator, and as the amplitude indicator and zero indicator are both measured for the illiquidity of the stock, so that we can come to the result that the margin trading balance has positive relationship with the stock liquidity. And for the third group, which was the relationship between margin trading balance and the annual turnover, which as the annual turnover was directly measured the stock liquidity, so that we can come out the results that the margin trading balance has positive relationship with the stock liquidity, which prove the hypothesis first. One. Then was the result about the moderating effect. Pay attention to this number as the firm size has both correlated with the margin trading balance and the stock liquidity. We think that the firm size maybe has a moderating effect between the margin trading balance and the stock liquidity. And through the result, we can find that it still has the significant relationship with the variables, which is multiple with margin trading balance and the firm size with the amplitude indicator, so that it can prove that the firm size has a moderating effect between the market trading balance and the stock liquidity. Then let's talk about something about the robustness check. The first one was the sub-period before and after COVID-19. The group one shows the regression from 2010 to 2080, which is before the COVID-19. And the second one was from 2019 to 2021, which was after the COVID-19. Look both these numbers, we can find that the margin trading balance was negative, has negative relationship with the amplitude indicator both before and after the COVID-19. But focus on these numbers, we can find that the second one has bigger numbers in the absolute values, which from which we can find that the positive impact of the stock of the margin trading on the stock liquidity may be increased during the COVID-19. The last one I'd like to introduce was about the two-stage least squares and horseman test, which is used to reduce the exogenous issues that may arise from simple selection barriers. And we choose the CI as our as our instrumental variables, which was the SPY training concentration, and it was correlated with the margin trading balance, but not with the amplitude indicators. We can find that in the first stage of the 2SLS, the CI has a significant relationship with margin trading balance, and after the work with the instrumental variables, we can still find the relationship with the margin trading balance and amplitude liquidities. Maybe it was not as significant as before, but I think it can in some degree improve that the margin trading balance has the relationship with the amplitude liquidity. So I think during this test, we can find that the research result is reliable. Then let's come to the conclusions. During the research, we can come out this conclusion that the market trading has a significant positive effect on the stock liquidity. The results support that the relationship hypothesis that the market trading balance and the stock liquidity has positive relationship, and and also the COVID-19 hypothesis, which is the positive impact of market trading on stock liquidity, has increased during the COVID-19 pandemic. Then was the moderating effect hypothesis. It shows that the firm size exists a positive moderating effect on the relationship between market trading and the stock liquidities. That's all I want to introduce. Thank you for your listening.